Understanding interest rates and how they impact mortgage payments. Interest rates are a critical component of the financial world, affecting everything from savings accounts to mortgage payments. For many, the term interest rate might seem abstract, but its influence on personal finances, especially when it comes to mortgages, is profound. In this video, we'll delve deep into the mechanics of interest rates, how they impact mortgage payments, and explore which types of interest rates might be better suited for different financial situations. Whether you're a first-time home buyer or considering refinancing your home, understanding interest rates can empower you to make informed decisions. What are interest rates? At its core, an interest rate is the cost of borrowing money. When you take out a loan, whether it's a mortgage, auto loan, or personal loan, the lender charges interest as compensation for providing the funds. Interest rates can be influenced by various factors including central bank policies, economic conditions, and inflation. Fixed versus variable interest rates. Interest rates on mortgages generally come in two main types, fixed and variable. Let's break down what each means. 1. Fixed interest rates. A fixed interest rate remains the same for the entire term of the loan. This means your monthly mortgage payments will stay constant, providing predictability and stability. Fixed rates are often preferred by those who want to avoid the uncertainty of fluctuating payments. 2. Variable or adjustable interest rates. Variable interest rates can change periodically based on an underlying benchmark or index, such as the prime rate or LIBOR. These changes can occur monthly, quarterly, or annually, depending on the terms of the loan. Initially, variable rates might be lower than fixed rates, but they carry the risk of increasing over time. Interest rate impact on mortgage payments. The interest rate on your mortgage directly affects your monthly payments and the total cost of your loan. Let's look at how different interest rates can impact mortgage payments through an example. Example: scenario, loan amount, $300,000, loan term, 30 years. Fixed rate mortgage, interest rate, 3.5%, monthly payment, approximately $1,347, variable rate mortgage, starting rate. Interest rate, 2.5%, initial rate, monthly payment, approximately $1,185 initially. At first glance, the variable rate mortgage appears more attractive due to the lower initial payment. However, the potential for rate increases means your payments could rise in the future. Understanding this risk is crucial when choosing between fixed and variable rates. When fixed rates might be better. If you plan to stay in your home for many years and want the security of knowing exactly what your mortgage payment will be, a fixed rate is often the better choice. Fixed rates provide peace of mind and make it easier to budget for other expenses without worrying about fluctuating mortgage payments. If you anticipate that interest rates will rise in the future, locking in a fixed rate now can protect you from higher costs later. When variable rates might be better. If you plan to sell or refinance your home within a few years, a variable rate could save you money with lower initial payments. If you expect interest rates to fall, a variable rate mortgage can allow you to benefit from lower payments over time. The lower initial rates on variable mortgages can make homeownership more accessible if you need a lower monthly payment to qualify for a loan. The cost of interest over time. To further illustrate the impact of interest rates on mortgage payments, let's compare the total cost of a fixed-rate mortgage versus a variable-rate mortgage over the life of the loan. Fixed-rate mortgage interest rate 3.5%. Total payments over 30 years, $484,968. Total interest paid, $184,968. Variable-rate mortgage, interest rate, 2.5% initial rate with possible increases over time. Total payments over 30 years, highly dependent on future rate changes. Total interest paid, potentially lower or higher than a fixed rate, depending on rate fluctuations. If the variable rate increases to an average of 4% over the life of the loan, The total payments would be approximately $515,609, with total interest paid around $215,609, highlighting the risk involved. Interest rates are influenced by broader economic conditions. Central banks, such as the Federal Reserve in the United States, adjust their benchmark rates in response to economic indicators like inflation, unemployment, and economic growth. These adjustments trickle down to consumer interest rates, including mortgage rates. When inflation rises, central banks may increase interest rates to cool down the economy and curb spending. Higher interest rates can make borrowing more expensive, reducing demand for loans. In contrast, during periods of low inflation or deflation, central banks may lower interest rates to encourage borrowing and stimulate the economy. During periods of strong economic growth, demand for loans increases, which can push interest rates higher. Conversely, during economic downturns, central banks may lower interest rates to make borrowing cheaper and stimulate economic activity. How mortgage lenders set rates. Mortgage lenders consider several factors when setting interest rates for individual borrowers. These factors include credit score. Borrowers with higher credit scores typically qualify for lower interest rates because they are seen as less risky. Loan-to-value ratio, or LTV. The LTV ratio is the amount of the loan compared to the appraised value of the property. Lower LTV ratios can result in better interest rates. Debt-to-income ratio, or DTI. Lenders look at the borrower's DTI ratio to assess their ability to repay the loan. Lower DTI ratios can lead to more favorable rates. Loan amount and term. Larger loan amounts and shorter loan terms can affect the interest rate offered by lenders. Market conditions. Prevailing economic conditions and competition among lenders also play a role in determining mortgage rates. Strategies for securing the best mortgage rate. Securing the best possible mortgage rate can save you thousands of dollars over the life of your loan. Here are some strategies to help you get the best rate. Improve your credit score. Paying down debt, avoiding new credit inquiries, and correcting any errors on your credit report can boost your credit score and qualify you for better rates. Increase your down payment. A larger down payment reduces the loan-to-value ratio, which can result in a lower interest rate. Shop around. Different lenders offer different rates, so it's important to shop around and compare offers from multiple lenders. Lock in your rate. Once you find a favorable rate, consider locking it in to protect against future rate increases. Consider discount points. Paying discount points up front can lower your interest rate. This can be a good strategy if you plan to stay in your home for a long period. The impact of refinancing. Refinancing your mortgage can be a powerful tool for taking advantage of lower interest rates. When you refinance, you take out a new loan to pay off your existing mortgage, ideally at a lower interest rate. This can reduce your monthly payments and the total amount of interest you pay over the life of the loan. When to consider refinancing. Falling interest rates. If interest rates have dropped significantly since you took out your original mortgage, refinancing can help you secure a lower rate. Improved credit score. If your credit score has improved, you may qualify for a better rate than you did initially. Change in financial situation. If your financial situation has changed, refinancing can help you adjust your loan terms to better fit your current needs. Potential downsides of refinancing. Closing costs. Refinancing can come with significant closing costs, which can offset the savings from a lower interest rate. Extended loan term. If you extend the term of your loan when refinancing, you may end up paying more interest over the long term, even with a lower rate. Qualification requirements. Refinancing requires going through the loan approval process again, and not all borrowers may qualify for better terms. Conclusion. Understanding interest rates is crucial for anyone considering a mortgage. The type of interest rate you choose can significantly impact your monthly payments and the total cost of your loan. Fixed rates offer stability and predictability, making them a good choice for long-term homeowners who value consistency. Variable rates, on the other hand, can offer lower initial payments and potential savings in a declining interest rate environment, but they come with the risk of future rate increases. By staying informed about economic conditions, improving your credit score, and shopping around for the best rates, you can make savvy financial decisions that align with your goals. Whether you're a first-time homebuyer or looking to refinance, understanding how interest rates work will empower you to make the best choices for your financial future. Thank you for watching. We hope this video has provided valuable insights into how interest rates impact mortgage payments and helped you understand which options might be best for your situation. Don't forget to like, share, and subscribe for more financial tips and insights.